first session is financial sustainability and growth. Let me invite Dr. T. Palaniappan, founder and chairman of the Medway Group of Hospitals, senior consultant in internal medicine and diabetologist. Welcome, sir. Next, I invite Mr. Natesan, senior vice president, claims network and border management of Star Health Insurance. We welcome you. Dr. Arun Palaniswami, MBBS internal medicine and PGXMP, executive director of KMCSC Hospital, trustee of KMCS Research and Education Trust. Welcome, sir. And I welcome Mr. Sivaramakrishnan R, who is the co-founder and CEO of the Sincere Syndicate and Corporate Services.
Thank you. We have a wonderful panel, very mixed. We have non-finance, non-medical professionals and medical professionals who are running hospitals, somebody newly into hospitals, expanding rapidly, somebody who's already into a legacy of hospitals. We have somebody from the insurance sector, health insurance sector, which I think is very important for nowadays. So let me start with Mr. Sivaramakrishnan, who is a financial whiz, and he does a lot of healthcare funding also. So, Mr. Sivaramakrishnan, I'd like to start with you. What should be the financial indicators for a hospital's financial sustainability and its necessity? What should be a report card of the hospital to say that you're performing well, and how do you go about it? For many of the doctors, don't even know how to read the balance sheet and this thing. So, how can you help us in saying what are the points we should be looking at? And if you can, I think you have a presentation, sir. You can come here and do it if you want.
Vanakkam Madurai. It's a privilege to stand before the agents of God, the magical hands of God, which you possess, have been instrumental in treating and curing several lakhs of patients. You have created wellness and happiness in the society, and we have been the source of all happiness of families at large. Pranams to you. Medical profession is a very noble profession. It has got those features that are so much deeply endowed in it, which aren't there in any other profession. I am a chartered accountant by qualification. With all due respects to our own profession, I can definitely admit that we would not be able to create as much value as healthcare professionals do if one is going to serve. We've got an enormous opportunity to serve mankind, right? But having said that, is the presentation on? Yeah. Having said that, I think running a healthcare enterprise is all about running a business too, isn't it? Though one might run with a lot of charitable mindset, it's all to do with making profits too. One wouldn't be able to do charity unless one is profitable. It has to stand on its own legs. Unless we are profitable, unless we are going to be creating wealth, it isn't possible to do what we are said to do. Can I just move on? Okay, yeah, fine, got it. Okay, got it. Thank God we are in India, my friends. We're in an extraordinary phase of transformation, a phase of unprecedented growth that we have never witnessed, perhaps not in the last 10 or 15 years. I would dare to say that something that we have not witnessed in the last 100 years or so. Such is the extraordinary phase of unprecedented transformational growth journey that all of us are part of. This wave of transformation is going to take all of us to great heights. If you're going to just be part of it, we don't need to do anything extraordinary there. Just be there. Don't get out of the scene, right? I'm saying this from the perspective of creating value and wealth for all stakeholders at large. Such is the transformation, right? What were we 25 years back and what are we? But having said that, it's very important to be present inside the system. From a financial landscape, these are three very important activities that you see on the screen out there. This is what we do. Just to give you a brief perspective, We create wealth for several hundreds of families. We manage about 1,500 crores of corpus, investing across diverse asset classes. With the grace of God, we have been endowed with the responsibility of preserving, growing and multiplying wealth for all these families. And we have been able to grow money at more than 25% annualized returns in the last 10 years, meaning which we have been able to grow the hard-earned funds of people by as much as about 10 to 12 times every 10 years. That's what we have been doing in wealth creation. Investment banking is all about working together with entrepreneurs, creating value and wealth for stakeholders, raising funds in the form of debt and equity. And risk management is to perceive things that are not visible in front of our eyes, right? And creating and implementing measures to manage those risks. I think the profession of healthcare is about risk management, isn't it? My friends, this is something very important at a very basic level to understand. The basic problem of an entrepreneur is to think that, well, if you ask him this question, what's your business all about? He would say, well, I am no different from the business. Is the company different from ourselves, first of all? If you're, first of all, believing that the company is nothing different from my own self, then we are making a fundamental error. So business assets are very different from the personal assets. You need to make a clear distinction. It's wiser to have a private limited company or LLP or corporate entity so that we can differentiate between the personal assets and the private assets. This is true for all small and medium enterprises. Even if you're not going to have a corporate enterprise, it's very important to differentiate even while you run your proprietary concerns or partnership firms too. They're very different from one another. How do we evaluate spending money, investing money? Every rupee of money that is earned in business, earned in your hospitals, earned in your healthcare business needs to be redeployed somewhere. What are those key important parameters that you apply in deployment of money? I can talk about important parameters in healthcare such as ALOS or RPOB, which I'm sure all of you are familiar of, right? But before, probably the successful entrepreneur sitting here would also be implementing that, seeing that every day. But before even getting into that point, it's very important to understand the most important measure, single most important measure that one needs to look at before deployment of capital. Where are you going to be deploying it in, right? Whether it's going to be a hospital or you're going to be run a chai shop, it's return on capital employed. Unless and until you're going to be seeing return on capital employed that is meaningful, there's absolutely no point in deploying money. So you need to be calculating return on capital employed in every single rupee of your deployment of money. Other important measure to look at is payback period. Why am I talking about this payback period and return on capital employed? Because we invest in equipments, we invest in doctors, we invest in consultants, we invest in buildings, so on and so forth, right? For every rupee of money that you're going to be spending, unless we are calculating this before we venture into that investment, perhaps we may not be successful. Calculate this properly and understand this. Once you are sure that it's going to be above the levels required, then go ahead. Now, what is return on capital employed, ROC? I don't want to use technical jargons and keep boring you today, but unfortunately I have to use some jargons. Return on capital employed stands for every rupee that is earned on the money spent, money invested in business. Right? Higher the return on capital employed, it's better, isn't it? It's very as simple as that. What brings the return on capital employed down? When businesses are heavily asset oriented, the return on capital employed tends to be lower. On the contrary, today the best way of running a business, there was a large hospital owner who came to us a few months back and is checking out with us if they can, for the purpose of expansion, if they could acquire a hospital, acquire a building, large land and building, and then put up a hospital there. The first question that we asked them during board meeting was to understand if they are running a healthcare services business or are they running a real estate industry. If they are part of real estate, perhaps acquiring a land and building would make sense. But if you're not running a real estate industry, but the core is to provide healthcare services in the finest of its pristine form, then why should we acquire hospital, land and building? Perhaps the money is well spent in equipments. Perhaps the money is well spent in providing high quality healthcare and working capital, rather than investing that money in land and building. We could lease that land and building. Therefore, asset-light models are the ones to go with. What is payback period? It's very simple. How long does it take to get the money back from profits you earned in the business, right? So just take a simple case. Somebody is investing about 10 crores of capital And if the net cash flow that it's going to generate is about 4 crores per annum, then the payback period is as much as 2.5 years. As simple as that. Please calculate a payback period. I have seen have had the good fortune of working with several thousands of doctors, hospital owners in the last 8 years. I had the fortune of speaking in several IMA forums. Having worked with them, I see the strange fact that doctors, largely the healthcare professionals, are little wary of numbers. I believe the reason is that, engineers, forget chartered accountants, engineers also go through study numbers during their preparatory days, but doctors do not study statistics or mathematics. As a result, they are wary of numbers, they are a little apprehensive about when you talk to them about numbers, right? But it's very important to calculate payback period before you venture into any investment. As a result of not knowing these payback periods and return on capital employed, I've seen so many hospitals putting up machineries, equipments, constructing new premises without fulfilling the existing, without utilizing the existing premises and equipments completely. Without achieving full utilization of equipments, what's the purpose in going for the new one, right? Please calculate the revenue that you can generate from every new investment that you're going to make, the return on capital employed that you can make, and then go for it. So what is a good return on capital employed? Talk about payback period, talk about return on capital employed. What is it that makes it good? Generally speaking, return on capital employed of more than 20% is a good figure to start with. I can talk about so many hospitals, healthcare business, many clients of us for whom we help them achieve return on capital employed of more than 30% too, by operating on an asset-light model. But if you're not able to achieve return on capital employed of 20%, let me tell you, my friends, you need to ask yourself the question as to why do you need to go for these investments in first place. So, instead of opening new hospitals, one can look at expanding brownfield, right? Or investing in your own more equipments, because the payback period is much faster. My friends, the payback period in investing in equipments, be it a cath lab or ophthalmology equipments, so in all these kind of medical equipments, tend to be less than 1.5 years. And the return on capital employed could stand at as much as 40%. A greenfield expansion into a hospital, with new facility entails larger investment, longer payback period, which reduces the time it takes to take the money back. Therefore, try to go for brownfield expansion and try to lease as much as possible instead of acquiring equipments, right? So these are the crucial one. Where does return on capital employed matter? These are, I think, the most important things that on a day-to-day basis, all of you make decisions upon, right? Let me ask you this question. This is relevant. Return on capital employed relevant for this building and constructing hospital, equipment, human resources? Perhaps no. Consumables? Perhaps no. Because you're going to be spending on consumables on a day-to-day basis, right? But people tend to calculate return on capital employed on constructing new hospitals, putting up new equipments. But do you need to calculate ROC in your marketing spend as well? In consumables as well? In your operating procedures as well? Very few people do that. But in reality, you need to do that too. You need to calculate ROC and payback in each one of these investments they're going to make. If you're going to be having about pool of 10, 15 consultants or doctors into the system, shouldn't you calculate the ROC on the investment that you're going to make with those consultants? You should do that. If you start doing that, let me tell you, my friends, you'll be able to run your enterprise much profitably, and you'll be able to create a lot more wealth for yourself and more value for your patients and more value for the society at large. Therefore, maximize capacity utilization for every equipment that you have, maximize capacity utilization for every human resource that you have, right from HR to finance to consultants, right? And it's always advisable, all of us have become Google doctors, right? Now, for every problem, we tend to look into Google and try to manage it ourselves. What if I start doing cataract surgery myself? I was sitting with a doctor, a friend of mine in a hospital, and he had lumpy books behind him. I was asking this question, have you studied all these books? He said, yes. If I do study all these books, can I start operating like yourself? He was just laughed at me. Right? That's pretty much the answer. If somebody is going to ask this question, can I calculate it myself and do all of it myself? Right? The answer is there. Self-help is not the best help at all. Right? Take professional assistance. Seek professional assistance. Perhaps your auditors are not the right sort of professionals to assist you in these matters. Seek the help of finance professionals who are not auditors, who can help you in all these matters. These are don'ts that you should avoid. Avoid in expanding into businesses, passion overshooting budgets, investments without calculations. My friends, please look at this carefully. The purpose of investing money, every rupee of your money back into your business is to beat inflation, right? That's a basic premise of investments and creating wealth, right? Now, please understand this carefully. Investing your own capital without taking any sort of efforts, right? Just stay invested in the best of the companies in India, you could have generated about 16% return on capital employed, return on investments. Just investing money out there with the best of 500 companies of India, you could have generated 16% return on investment. Now, if you're going to be investing capital, not your time and efforts, but the time and efforts of visionary managers of the best of companies in India and the assistance of professional fund managers, you could have generated about 26%, 25% return on investment. In which case, you would have double money, probably about 10x in the last 10 years. We are saying this from our own experience of multiplying money for our investors. But which being the case, then what should be the return on investment that you should generate from your own hospitals? Why is that relevant? It's very relevant because over there, you're not only investing your capital, but you're investing all your time, effort, stress, and attention. And without diversifying, every pie of your money is getting invested in your business. Then shouldn't you achieve returns of well more than what the first two generates out there? Without your own efforts, if money is going to generate returns of 25% per annum, if you're going to be putting not only money, but all your stress, attention, without diversification, take the risk in business, shouldn't it generate returns of more than 25%? Isn't it logical? Please work on your numbers. Numbers are the basic stuff. Can I tell you something? Just take a look at your peers. It's a fantastic case to understand. This is the case of Narayana Hrudayalaya, Apollo Hospitals, KIMS, and Max Healthcare. If at all, 5 years back, you had 1 crore of rupees. Just you could have distributed across these top four companies, for healthcare enterprises of India, across Narayana Hrudayalaya, Apollo Hospitals, KIMS, and Healthcare. Just look at the kind of returns that it has generated. 2019, look, what was your profits in business? What was your profits in hospitals? Has it grown by about 5 times or 10 times in the last 5 years? Well, my friends, if you had invested the same money that you might had in these enterprises, it would have multiplied by about 5 times with Narayana Hrudayalaya, 5 times with Apollo Hospitals. KIMS, it would have grown by about 2 times in 3 years, and about 9 times in 3 years for Max Healthcare. That's the sort of returns these passive investments would have generated. The reason I am talking about this stuff is not to tell you that go and invest in all these companies and close down all healthcare enterprises. That's not the point at all. It's to understand if passive investments in such ventures in others' hospitals could multiply your money by horrendous number of 10, 15, 20 times in about 10 years period, then what is the kind of return that you should generate yourself by investing not only money but taking all the risks, all the time, stress, attention? Shouldn't you be generating returns of more than this? With this, I rest the case in front of you. Well, you need to calculate your RPOPs. You need to calculate all this stuff. May I take about 30 seconds to showcase the RPOPs of a bunch of hospitals out there? Would it? Yeah.
We'll do it after the...
Yeah. I think you need to calculate all these basic metrics to be able to generate returns. Wish you the very best ahead. I think these are the basic stuff to understand before you go ahead and venture into expansion in hospitals. Jai Hind.
Thank you. Thank you so much, sir. Very nicely put about return of investment. And so now, can I call upon Mr. Ram Natesan? We know that health insurance is now nearly 60 to 70% of any hospital's revenue. So what are the dynamics of healthcare insurance today, and what's the increasing impact in hospitals? How we can both have a win-win situation? I think many hospitals and insurance companies have a lot of tussles nowadays. So how do you think we can work together to make it winnable for all?
Thank you. Good morning, everybody. It's a pleasure to be here, and thanks for the invitation. Doctor, to give a lot of specific, I take your question in 2-3 parts. The first part is how the industry is growing. I remember I've been in the industry for more than 2.5 decades now. About 10 years back, when my memory goes right, in any hospital, if you see, the cash versus TPA business, which is the insurance business, were 80% cash and 20% insurance. Now it has come to 60-40, as Dr. Devadoss rightly said. This clearly shows the appetite in India for buying insurance, and COVID has really accelerated the health insurance awareness among the Indian public. More and more people are buying health insurance. But having said that, if you look at our large population of 140 crores, there is a large, almost a 70 to 80 crore population, which is called the missing middle, do not either have an insurance or have adequate insurance. as the industry grows at the rate of 20-25% in terms of volume, we are going to see more and more insurance customers landing up at the hospital for their healthcare needs. So there is a huge demand which is going to be generated in the next 5 to 10 years. And with IRDA, with government putting more emphasis on having basic health cover for each and every individual in this country, with out-of-pocket expenses, which was 80% coming down to 50% and lesser. So you are going to see we are currently on a sweet spot. Now, to answer the challenges between the payer and the provider, today is that the major thing is that as payers, we are a highly regulated industry. So I do not have any comfort or any leeway to tweak any of my business models without the regulatory approvals, which comes with a lot of restrictions. And at the same time, you look at this business has to be sustainable for us. I don't know how many of you sitting in this room, in this hall, know what is the margin of a healthcare insurance business. Health insurance business doesn't operate on a margins like any other business. I have not seen any business which has got a lesser than 8 to 10% margin. But whereas health insurance, if you look at PBT, the profit before tax, it is less than 1%. So we operate on a wafer thin margin, and the frugality of the cost and how you manage your business becomes extremely important to become sustainable business model for this industry. In India today, if you take any health insurance company, barring one or two, no one is making money. In fact, they are making losses. That's largely because the claim ratios are increasing, the incurred claim ratios are increasing, the loss ratios are increasing. And on top of that, in India, we have close to about 20-25,000 network hospitals. And unfortunately, in some pockets of India, where the prevalence of serious deficiencies of hospital during claims is also increasing, which really puts a lot of burden on the health insurance companies. Now, as far as the tussle is concerned, I don't think it's a tussle. I think both are in business. Hospitals have their own numbers to catch up. We have our own numbers to catch up. It's at the end of the day, it is a business call. So if I'm running a business, forget about payer or provider for a moment. If I am running any business and if I'm sitting in front of a vendor or a partner, I would like to negotiate as much as I can to actually save for my organization or save for my business. Likewise, the other side. So the same principle and formula applies between the payer and provider also. So it's more a business call, it's more a give and take, it's how you negotiate, how you influence, and how you get the best rates for your business, vis-a-vis the hospital also. And let me also tell you, friends, that now, payer and provider is a relationship which has to be sustainable. I think insurance companies needs hospitals as much as hospitals need insurance companies. So it's a win-win situation for both. Both have to marry together and live together. That's the way it is, in the best interest of the patients and customers. But we will have to find a model which is more sustainable in nature. With the healthcare inflation cost, I also understand the challenges of hospital because I worked in the industry for many years. The rising healthcare costs, the inflation, also putting a lot of pressure on the hospitals to actually increase the tariff. Unfortunately, from a health insurance point of view, I cannot increase my premiums. I cannot, tweak my business model the way, hospitals have the liberty to do so. So that is where the challenge comes from. And added to that is the cost and the margins. So these are the 2-3 areas, Doctor, which is extremely challenging for a payer and provider to arrive at a consensus. But I can tell you, Doctor, the way the business is growing, the way the market shares are growing, I am sure both of them will come on a common ground and definitely find a path which is mutually beneficial to both of us.
Wonderful, sir. Thank you. I think let's get to the common ground very soon, I guess. I asked Dr. Arun Palaniswami. I think we're very happy that he's here. He's one of the legacy hospitals of Tamil Nadu, what they were today and what they have grown today. And so I'd like to ask Dr. Arun, what is the perspective on sustaining and growing a legacy healthcare institution as well as the strategies involved in managing it effectively?
So looking at how do you grow from a long-term perspective, next slide. I got this from a very wealthy industrial family in Chennai. long-term thinking. His basic goal is, what is your underlying goal? Why did you start the hospital? What is the purpose of your institution? And beyond that, that's how you frame a financial structure and a growth model. So what's your goal? Is it to serve the poor? Are you going to save India? Is your based on a particular mission? I'm going to save this many people from blindness. Are you going to save this many pediatric surgeries? Because each will then frame your goal. I think we went on a lease versus buy mode. But as you know, if you're coming from a charity hospital and you're to serve the poor, you can't rent a facility for 1 crore and then charge 100 rupee fee. Your growth model will be very slow, but then at the same time, you're fulfilling your mission. It means you have to target what your goal is. Based on this, it'll change a lot of your financial structure, how you hire, who you hire. Go to the next slide. Next slide, okay. Who are your stakeholders? I think he was talking about some financial investment, and it's true that private equity has been a big boon in India. You see a huge amount of facilities grown, but private equity is looking for expectation of some 15 to 25% return on their investment. You can't expect a facility who wants 15 to 25% investment has to align with what you want to do. KMCH personally never took private equity, but I can personally tell from the 1990s, the hospitals first started in the first 10 years, half the big corporate hospitals failed. Fortis Muller has now changed hands 3 times, Global Chennai has changed hands 4 times. A lot of the people who took private equity and failed are not in this room because they have failed and they have gone out of the system. So there are those who can succeed, but then you have to ask whether this is the right model for you, whether in what type of investors. If you're taking on I'm a corporate, so I do have to answer, I have to produce returns for my investors. If you're a trust and you're a charity, that means you are specific minded that they want to do charity work. They may not be able to provide the facilities that they provide. I think I recently ran into a pediatric cardiologist, cardiac thoracic surgeon, who wants to do lots of pediatric cardiothoracic surgeon. He was picked out by the chief, the head of the hospital. This is a national India chain. Put in that facility by that trust, and he found out there's no support. The neonatal ICU doesn't have ventilators. There's a huge amount of financial. Each child in has to find someone to sponsor it because each of them requires lakhs of expenditure, and then they were not allowed to charge fees. So then it became very negative. And without any approval, that cardiothoracic surgeon now wants to quit because the model does not fit, the financial model does not fit what he was trying to do. Go on, next slide. So the next slide, sorry. What is your environment? Recently I was in Korea. Korea, for example, I went to this large hospital, fantastic. They have putting in a heavy ion machine, they have 1 proton, they have 10 Linacs, 3 tomotherapies, lots of brachytherapy. When I went and then they were showing me their huge cancer facility, and when I watched around, they showed, hey, that's our pediatric super specialty hospital. They're struggling like anything because Korea's population birth rate went from replacement level 2 to 0.8, and there's barely any children. Tamil Nadu, as you know, has now gone from a replacement rate of 2 with 2,000. Now it's only having 1.5, 1.6, meaning the total number of pediatric children are now decreased by 25%. And as you know, we produce now at least 12 more medical colleges, each producing X amount of pediatric PGs. So we're producing more pediatricians, and our population of children is going down by 25%, and we're not producing any geriatric doctors. So you have to frame in what is your business environment you're going to set up your thing is too. We see AI is going to come in. Can you start a radiology chain when majority of the thing will be AI based? Are you going to start a pathology chain when most of everything is going to go to AI? So these are the kind of things which we're going to. In US, they're talking about the death of doctors who don't do procedures because this is the next generation of AI is going to come, and they're going to be telling you what to do. The AI in 20 years may be smarter than the doctor, and you may be following protocols by the doctor. Maybe a doctor there, but you may be seeing double the number of patients with an AI-driven logarithm. So are you prepared for that future? Is your long-term vision, when you see legacy, are you prepared for the future that it has? And you must go in for changes, and you have to adapt. What is your long-term goal? As in, I think they talked about workforce demographics. We are going to be in it forever. In India will be the pain. You know, everyone's going to complain that we don't have any senior staff, because the world is going to be age very quickly. And India is the cheapest labor. And Japan, China, everyone is going to be rapidly aging, and we're the highest supply of nursing. So until you can match about a 1 lakh salary for a nurse who wants to go abroad, for the next 30, 40 years, the entire population of Western Europe, US, Japan, China, Korea is all going to age. And you trying to hold on to your nurses thinking that at some point you can get some percentage, but you're trying to think that we're going to stop the brain drain I don't think is going to be quite realistic. And you have to do your competition SWOT analysis. Not everyone can do the same thing as everyone else can. So where do I go? I'll deal with cash flows with suppliers and cash flow with insurance that came in. What's going to happen? Go to the next slide. So we're now looking at almost the market. This is my favorite thing from my old business professor. Market forces are like the weight of the ocean. They think they want the perfect market where there's 0% profit or near zero. They want medicine to be like salt, meaning there'll be no margin. Whatever you buy Tata salt or the regular salt, that's how much margin you'll have. So the only things which are keeping you are technological capabilities, enhanced services, marketing, and brand. These are the long-term things you have to build as an institution. Because let me give you an example of what market forces are coming. You're all slightly very lucky, I think. We're now in a golden age. A lot of people with we talked about people paying in cash. You guys now pay your suppliers after 30 daes. The wholesale margin is 10%, the retail margin is 10%. Patient shows up to a hospital, you prescribe a drug, you pay the supplier after 30 days. So in some sense, your cash flow is you're borrowing from your suppliers and then paying for your patients. Some of you, let's say Chennai market, it's now going, sometimes they go up to 90 days. People are happily paying their suppliers after 90 days. When insurance is going to kick in is that you're not going to get cash first, cash on day one for a lot of the models. Some of the cash models will come after 30 days. Therefore, there's no cash flow. And just to give you an example of how restricted some markets are in India, if you go for your biscuits, what you get off HUL, what you get off your milk bikkies, your Good Day biscuits, they work on 1% margin. I think one day somebody in accounts wanted to pay them after 30 days. After 2 weeks, there's no biscuits in our hospital. Because after 2 days, no supplier in that market would work for us or give us anything, because they work on a model where you only give 1%. And now we're going into a model where you are now going under 30 days. Under 30 days, if you're really going to press for margins, you have to improve your cash flows. We worked with a large number of corporate hospitals who are sitting on 90 days of stock. That means they have 30 days. KMCH, for example, models has only 10 days of stock. And we rotate our margin 3 times a month. Some people are sitting on 60 days, 90 days because they don't. But once you get to tighter cash flows, your amount of stock you should be able to keep is less. Your amount of payment you're going to have to do is rotate less. As the margin becomes thinner, you want to get better deals. That means you have to pay earlier and faster. If you want to pay 90 days, you get higher markups. So if you want to get tight and work within an insurance budget, that means you have to be cash efficient. If you're not cash efficient, you're going to be you're just going to suffer from the weight of market forces. So I try to be very brief in this thing. So these are the only things which held us in the long term. As a long-term legacy institution, it's just not about what happens next year. You don't have to say about what's going on. That's climate change, demographics, everything. What is India willing to pay for? What is it not willing to pay for? That is all what you're having to understand. I'd like to thank and take questions at the end of, I guess. Thank you.
Thank you, Dr. Arun. Excellent insights, and you're sharing your experience about your KMCH and how cash flow is important and what we should know about. Talking about cash flow, now I come to Dr. Palaniappan. You've expanded rapidly, raising a lot of funds, and what are the ways to do this? How can you, what is the advice to younger doctors or healthcare providers to maintain financial sustainability and raise funds?
I thank AHPICON for giving me an opportunity to share my insights on this. First and foremost, the talk is about financial sustainability and growth. I would say COVID is the best phase where you can look at a financial sustainability and growth. That's the only honeymoon period for the healthcare industry. Right. Financial sustainability and growth doesn't go hand in hand. It's such a tough situation. You have to be stable and you have to grow, which is not possible. You have to go from your comfort zone into an uncomfortable zone to grow. That's always a dictum. So being financially sustainable and stable, the growth will be very, very difficult. Well, raising funds. First and foremost, you need to understand whether you want to raise a debt or you want to get it on base of an equity. That's something which is very important. Everybody's mind we should have. As doctors turning entrepreneurs, I would definitely say the financial knowledge on this perspective of raising funds is pretty poor with us. There are two reasons for it. One is all doctors get emotionally attached to the business. First and foremost, as Sivaramakrishnan said, keep the business separate, your personal set separate. Same way, treat an hospital as an hospital. Don't think that you are an hospital. It should be a promoter driven, not promoter dependent. Most of us make a mistake of being a promoter dependent. If you are a promoter dependent, no venture capitalist or no PE guy will look at you. That's number one. Raising funds. Well, most important, what a PE guy will look or a VC guy will look at us. First and foremost, the geography, and your business model has to be very compelling for them to invest, because there is no innovation in healthcare industry. AI come, that's from a different industry, we are going to implement it. Can we do a tonsil surgery from back? No, you can't. You have to do the tonsil surgery in a conventional way. Maybe you can use a gold knife or you can use a laser. So technology and innovation is not possible in healthcare industry like what happens in a manufacturing or a software industry. So your story has to be really compelling. So your business model has to be very attractive. Your EBIT or an EBITDA has to be very attractive for the investors to see that, okay, this is a good opportunity for me to invest. Well, getting a PE partner is very easy once your story is compelling. But the story doesn't end there. Having a PE partner or a VC guy on board is like getting married. Sometimes it is very fun and frolic and it's like a bride. At rest of the time, it is like a mother-in-law when the quarterly results come. They sit on your head. They expect what is the numbers, right? They really grill through. So initially getting money may be very easy, but you have to get to your targets. Otherwise, it will be a Chandramukhi in the board meeting. All the P and VC guys will be a Chandramukhi and you will be like Rajinikanth and Prabhu will sitting there how to manage. That's what it is. So don't jump into the conclusion that raising funds is a solution for everything. Yes, you need to have a goal. Whether you are going to list it, whether you are going to go for an IPO, or you are ready for an amalgamation, or you are ready for a merger, or you are ready to be acquired by someone, all this has to be a clear roadmap, say 4 years, 5 years down the line. And I would definitely say, please don't depend on one person to run an hospital. Never ever depend, right? Build your brand. Always think that the institution is much bigger than the individual, and don't depend on the individual. Sometimes it will be very hard, even though we are doctors, we want to be pampered from everywhere. But unfortunately, to run a healthcare business, never ever depend on one specialty, never depend on one individual to sustain the entire growth. As I said, a compelling business plan, EBITDA, your presence across geography. You may be a very strong player in one region with one hospital. They don't like it. They want your presence in multiple places, because after all, who's a PE guy or a VC? He's an investor who borrows money from others and invests in your company. So they will be definitely looking for a 5x, 10x or 15x returns. So you need to deliver that kind of returns, and it's a valuation game. If you look at the PBT or a PAT right now during the time of expansion, it is foolishness. You can never have a PBT or a PAT. You will get only after you expand and it gets matured. And R is kind of a model, healthcare system is a model where it takes a long time, unlike other businesses. It takes a minimum of 4 to 5 years to get the return on the capital employed of say 18 or 20%. 20% is too much. I would say 18% is what it's realistic. So return on the capital employed is 18% you want to make, it will take at least 4 years. So our industry is not something which is very easy to make like a software or very easy to get that kind of a valuation as well. So you need to really work hard to get that kind of a valuation to go to the next stage. The advantage of having a PE on board is they bring in a lot of knowledge to you. There is a corporate governance, more transparency. You will be much more educated to look at the numbers. How do you look at it? Well, when the corporate guys come in, when the PE guys come in, of course your business model has to change. There has to be a pivoting happen. At every stage, like what Dr. Arun was telling, you need to pivot based on the industry, based on the new technology, based on the knowledge sharing, knowledge transfer. You have to pivot every time. You can't stick on to the same thing and you can't continue for ages. So these are all the points which a PE guy will look at. And most important is you will have an exit option. Majority of the time, the father starts, the son takes over, the grandson, whether he likes it or not, he has to run the hospital. Well, you should not be put in such a situation. You should have a corporate governance. You can hold say about 20%, 30% or 15% stake, or it could be even a major stakeholder, but you need to have delegate people at different stages to run it in such a way it is seamless and it is not dependent on one single person. So at the end of the day, the money is available in the market. You should have a compelling business plan. You should make sure that the PE guys are convinced with your idea, or I would say selling your story. And then you have a big financial sustainability, because you don't see, I strongly believe that a debt equity ratio for any hospital should not be more than 1. Some industrial players, like they've shown, they have a debt equity ratio of 1.5, but 1 is the most conservative thing. So I would strongly suggest to leverage your equity, build your brand, take it to multiple geographies, multiple locations, a compelling business idea, so the PE guys don't reject you. Of course, it may look very easy when I sit here and say that go to a PE or a VC. Before I raised my first fund, I would have met close to around 10 to 15 PEs. I would have presented my ideas and everything, the projections for the next 10 years. It's not that easy, but yes, you need to keep on trying, and your numbers should speak, your brand should speak over a period of time. So we started as a 70-bedded, today we are a 780-bedded hospital. So that's the story, and definitely there is a lot of options. There is huge amount of money influx is going to come into the healthcare industry. We need to keep our eyes and ears open, and we should make sure that we deliver what we promise, not only to our patients, to our investors as well. Thank you very much.
Thank you so much, sir. A very good insight into how you should have a roadmap and clear vision and what you're going to do when you're going to seek for funds. I think very important for everybody to know. We are at the end of the session. We'll just have a couple of questions. I think if we have time, anybody wants to, from the floor? Yes, yes, sir. Yeah, we can be quite brief and yeah.
Gentlemen, we have a stand mic in the center of the hall, which you can utilize for asking the questions, please.
So now the health insurance scenario in India is, we have a capping on the premium. Insurance sector is struggling, and that load is coming on the hospital, and our cost of expenditures are going up year on year. He was telling that we will come to a kind of, we'll join together and make it. Rather than reducing and capping our prices, we should find a solution to increase the premiums or various sectors. So I like to hear from him, what is the plan the insurance sectors have to help the hospitals to sustain? Otherwise, if it is going in the same way, we are not going to sustain in another 2-3 years. So I want to listen from you, what is the solution the insurance companies are going to have, sir?
Thanks for asking that. I'm glad you asked it. I think we are the largest health insurance company in the country. by a very fair margin. We hold a 34% market share. And every third policy in India which is sold by Star and bought by the customer. Now, to answer specifically your question is that the way forward, I think, is that there are two things. Every industry in this country has gone through a disruption stage. We have not seen disruption happening in the health insurance space. That's one area where we are looking at. But to make this business sustainable and viable both for the payer and provider, it's our view actually, how the industry is taking it, we don't know. As pioneers of healthcare industry and the way our premiums are coming up and the kind of loss ratios we are looking at and the kind of fraud, abuse, waste in the system happening, the way forward we think is called the managed care model, which is very much prevalent in the Western region. And of course, we'll have to define a model for India. Managed care model and value-based care. These are the two things. We are already stepping into a value-based care. We call it an accountable care organization, which means that we will work with a set of, the products will be a network-based product. We will work with a set of providers with a pre-fixed pricing arrangement, with a captive business model, which will be a win-win situation for both the payer and the provider. This is a value-based care. Then there's something called as a managed care model. See, look, India and the other rest of the world markets, if you compare, I traveled to South Africa about a few months back and tried to understand the model there. There's a company by name Discovery Health Insurance. There, the entire market is driven by the payer. The entire Europe, West, everywhere is driven by the payer. It's not driven by the provider. Unlike in India, it's driven by the provider. Now, if you look at their model, they combine both preventive medicine and curative medicine in a single offering, which is not the case in India. What happens is, because today you have an insurance, you feel little uneasy, you go to the best hospital in your city and get admitted, where you don't actually warrant an admission. The hospital is not benefited. The insurance company is not benefited, because as a large hospital chain, you have a prefixed cost. Maybe you charge about, your ARPOB is about 30,000-40,000 per day. Just giving you an example. So that's the kind of outflow the insurance company will have to bear. So this is an additional burden. And please remember that health insurance companies do not generate any income other than the policyholders fund. So I am a custodian of the policyholders fund. It is my duty to ensure that while I pay the right claim, the remaining non-claimants also I need to seek justice for them. So we will have to strike a fine balance between settling the right claim, at the same time protecting the interest of the non-claimants. So the managed care model and the value-based model, which is going to come into India very, very soon, at least we are working on that very, very closely, is the solution I foresee to come in India in the next 4 or 5 years.
Thank you. Thank you, sir. Dr. UK, last question, sir.
I'm Ananthabhadraman. I've been working in the healthcare industry for almost 3 decades now. I worked in corporate hospitals in Chennai, Coimbatore, maybe in Trichy as well. One question to Mr. Sivaramakrishnan is it worthwhile just investing in hospitals and not running hospital like us? People like us work for hospital and simply invest. But one more question which I found very interesting is, I should quote Arun here, because in Kovi Medical Center I worked there for a long time. There they got public equity and they got debt. The advantage I thought that company had was they were not at the mercy of venture capitalists. The point is, the venture capitalists keep on chasing numbers. Every quarter they had to chase numbers. But a hospital which takes a loan has to answer only the bank. And if you pay the bank installments properly, they don't come and ask you what you are doing, what equipment, what specialty. They don't really interfere with the affairs of the company. So should I take it that a good public equity and debt will give you a lot of flexibility, maneuverability, and creativity in running the organization and make it profitable? That is one question to them. Another question, sir, for you on the insurance. In US and all that, the copay system is working very well. I don't want to go and fall before a Vande Mother train and come to you for treatment, okay? Nobody wants to do that. So if you have a copay system, then to that extent, the people will be a little restrained to come to the insurance, claim a lot of money because I have to pay, you have to pay. I think that's the best system, I feel. What is your comments on that?
Copay is very much existing in India, I think, but it is existing only in a very limited fashion, unlike in the US or UK. your treatment options are predefined in your policy terms and conditions. Just because you have a fever, you cannot directly go and get admitted in a hospital. You will have to go to the primary care center, get yourself tested and medically evaluated, and only then, if the doctor feels that you need an admission, only then you can go and get admitted. So we'll have to bring in those checks and balances, and then that will definitely come in India. But currently, to answer your question, sir, the copay model is existing in some of the policies where, like for example, in our company, I can say that, we sell policies for patients who are diagnosed with cancer. We have policies for patients who have been diagnosed with a cardiovascular disease and also had an episode of treatment. So there we have this copay, we have this limit setting. So it is available, but it's available at a very, very low price. But what happens in India with the aspirational quotient increasing and the sum assured going up? Today we have policies worth 2 crores and 3 crores and 1 crore sum assured, where there is no limit, no capping at all. So if somebody buys that kind of a policy and is paying a premium for that and getting admitted to a hospital, I cannot say anything to him. These checks and balances which I was talking about, how you triage patients from a primary to secondary to tertiary to quaternary care, I think if we can bring in that tier-based model in India, which I'm sure insurance companies are working and filing, we are working on some of the products like, that will really create a difference in the market. Thank you.
Anantha sir comes with a notion of experience in managing healthcare and also in healthcare technology. The first question, if all hospital owners turn out to be investors, then there is nothing to invest upon. First of all, right? If all entrepreneurs turn out to be investors, there's nothing to invest upon. Very important to run the business. But at the same time, there are a couple of factors to remember. Are you able to generate returns that just pure investments can generate while running the business? With so much of efforts taken, if you're going to be generating returns of only about, let's say, 15 to 20%, might as well, with all due respects, nothing wrong in pulling from wealth creation perspective, not from a service perspective. It's nothing wrong in pulling the money and investing the money elsewhere and sit on that. If wealth creation will have to be the only goal, right? Having said that, I think the biggest challenge that I see with doctors is this, that their entire net worth is consisting of their investments in their hospitals, which again is land, building, equipments, most of which is not actually owned by them because the first owner is the bank. It's only the second owner that the hospital owners are, right? The first owners are the bank because the equipments of the land and building have been mortgaged to the bank, have been hypothecated to the bank. It's very important that every entrepreneur, not only doctors, not only whosoever they are, whosoever we are all, we should have second sideline, second stream of not income but second stream of assets, which I can tell you with lot of conviction, assurance that that stream of investments, if properly done, can generate equivalent or perhaps more returns than what your own business can generate for you. That's a fact of the matter. Right? It's very important to have investments outside of your own business which can generate equivalent or more returns than your business, and it's very realistic. That's point number one. Point number two, the question is relating to whether we should have private equity, public equity, or debt. Right? I think if I were to pose this question back to the audience, which is the costliest form of capital, or which is the cheapest form of capital among these two? Equity or debt? Debt is the cheapest form of capital. Equity is the costliest form of capital. Because when you're going to be raising equity, whichever form of equity it is, whether it's public equity or private equity, you're going to be diluting your stake in the company, right? If you're going to be taking a loan, you're only going to be repaying the loan to the extent of the interest rate that you're going to be borrowing at, let's say 10%, 11%, or 8%. Having said that, there is a limit up to which you can borrow. So what's that limit? I'm going to tell you one parameter. About 18 years back, I used to head Kotak Mahindra Bank for Tamil Nadu and Kerala. Incidentally, I'm a sanctioning authority there for lending to small and medium enterprises. I've come across hundreds of hospitals, hundreds of varied enterprises. Number two, I was also holding a position in a private equity where we were managing about 5,800 crores. In a private equity, investing across multiple asset classes. Today, we run both. We raise both debt and equity. I'll tell you something very interesting. It is a very important parameter that each one of us should bear in mind. What's the maximum amount of debt that we can take? Beyond which, definitely you need to go for equity only. You cannot take raise debt, right? What's the maximum quantum? I'll define it like this. Take your EBITDA, right? EBITDA stands for earnings before interest, depreciation and tax, right? take that, it's a cash profit, as simple as that, the cash profit before paying your taxes. On that, just multiply that by 2 times, or the maximum that it can be is 3 times. Right? If your earnings before interest, depreciation and tax, let's say, is about 10 crores, for instance, the maximum amount of debt that you could have is about 2 times, or perhaps go up to 3 times, 30 crores. You should not go beyond that. There have been instances of companies having debt of probably about 7 to 8 times. There was a case in, I'm not, since we are SEBI registered for portfolio managers, if I mention name of a company, I need to give a disclaimer before that. I'm talking about name of a company, Max Healthcare or take, Medanta. Those were companies that had huge debt on their books about 5 years back. I think that was the case with several hospitals pre-COVID, right? And today, they were running at about 7 to 8 times of EBITDA as a debt in their books. In a matter of 4 to 5 years, they brought down the debt to 0. It's very wrong to run your business without debt. Borrowing is bad or good? I would say not borrowing is bad. Nothing wrong in borrowing money. So long as you can generate returns of more than the cost of borrowing. At least generate returns of double the cost of borrowing. That is, return on capital employed be at least 15% in your business. So long as return on capital employed is 15%, you can, nothing wrong in borrowing at 9%. So please calculate return on capital employed. So the first question is go for debt. And private equity is a precursor to going public. Let's say take this gentleman sitting with me. He has raised private equity because he's going to go public. And once you raise private equity, they will themselves take you along to public market because they need an exit, right? So, having said the last comment that I want to tell you something very important. We have this opportunity of going public without raising private equity too today, because we can go with the SME market, SME listing, where you can, even if your enterprise is generating revenues of 40 or 50 crores or 30 crores with some bit of profits, you could still get your company listed, raise equity, flow it back into business, build your brand, expand from there on. There are some challenges relating to SME listing in terms of valuation, but those are all matters for discussion for another day. Therefore, you have an option to be able to raise public debt, public equity by listing yourself on the SME stock exchanges. Thank you.
Actually, adding on to what Dr. Sir, first is debt. But the problem with the debt is the bank will definitely ask for a collateral. That kind of a property to keep it as a collateral. Apparently, what will happen? It will be a personal asset which will be pledged and will become a collateral. So you're putting your personal asset into play and you're raising a fund. So first will be debt. When you cross that stage, when you want to grow, you have to go to a PE or a VC player before you go to a public funding. Without that going to public funding, it may be a bit difficult. Not everybody can do it. And second, as he said, listing on the SME and not on the main board, the number of transactions happening in the SME will be very less. And the PE guys, if they come in, they will not allow you to list it on the SME board. They will make sure that you go only on the main board. So it's all 3 steps. Where you want to go, how you want to take it, where you want to reach is your focus and your goal. Based on that, you need to take a call.
Thank you, sir. I think it's a fascinating discussion. It's probably for a whole day we can talk about this. Unfortunately, we are running late, and I thank all the panelists for a wonderful talk. Thank you so much. On behalf of AHPICON, thank you so much.
I gently request the speakers and the chair to please stay back on the dais, please. Ladies and gentlemen, can you please give a big hand to the entire team for putting forward such an interesting topic for us to listen to, that we can sit and listen for hours together. Can I please gently request Dr. Giridhar Gyani to join us on the dais to felicitate the chair and the speakers, please. We now felicitate Dr. Raju Sivasamy for co-chairing the session. Dr. T. Palaniappan, Chairman, Medway Hospitals. Mr. Natesan, Senior Vice President, Claims Network and Provider Management, Star Health Insurance. Dr. Arun N. Palaniswami, Executive Director, Kowe Medical Center and Hospitals. Mr. Sivaramakrishnan R, Co-Founder and CEO, Sincere Syndicate and Corporate Services, LLP. Last but not the least, we would like to present a felicitation to Dr. Sathish Devadoss, please. Thank you to the entire team, and let's join for a group picture. Let us please step forward for a group picture, please.